Something in the U.S. banking system just fractured, and almost no one is reacting with the urgency it deserves. While most people were distracted by noise, a quiet regulatory filing slipped into a federal database like a pressure crack forming beneath a bridge. No alerts, no headlines, no warning from your bank, just a cold set of numbers sitting in plain sight waiting for someone to actually read them. And inside those numbers was a problem so severe it should have frozen every boardroom in the country. This wasn't a story about one reckless institution or a single bad decision. This was math. Balance sheet math that no narrative spin can fix. Losses large enough to erase an entire equity cushion and then keep going quietly hidden behind accounting rules that allow banks to pretend market reality doesn't exist as long as assets aren't sold. The loss is real, but it's concealed, like refusing to check the value of your house because you don't like what the market is saying. That illusion holds until the moment it doesn't. Here's what makes this dangerous. This filing didn't reveal an isolated mistake. It exposed a pattern, a system-wide vulnerability that has been building silently quarter after quarter. And if you've been told, relax, it's contained, understand this clearly. Containment only works when confidence holds. Banking is not just numbers, it's trust. The moment trust cracks, the math stops being theoretical. This is not doom for attention. This is not a conspiracy. This is a chain reaction that starts with hidden losses, accelerates through commercial real estate stress, and ends with something much larger than a single bank. When enough institutions are carrying assets worth far less than their books, claim a small shock can trigger forced selling, realized losses, and sudden insolvency. And in a digital system, that process doesn't take months. It takes hours. Before we go deeper, one quick favor. If you value original independent analysis that doesn't follow headlines but reads the filings instead, support the channel now. Subscribe and comment one below to let me know you're here from the start. That signal matters more than you think. Now let's peel back the curtain and walk through why this crack matters, how it spread, and why what looks calm on the surface is anything but. To see why this system is more fragile than it looks, you have to understand how stress is hidden in plain sight. On the surface, bank balance sheets still appear healthy. Capital ratios look acceptable. Deposits seem stable. But underneath those clean summaries is a structural illusion created by accounting rules that were never designed for a sharp regime change. Banks are allowed to label large portions of their assets as held to maturity, which lets them ignore market prices entirely as long as nothing is sold. On paper, losses don't exist. In reality, they already do. Refusing to sell doesn't erase a loss. It only postpones the moment it has to be admitted. This works in calm markets. It fails the moment liquidity matters. When depositors move money, banks need cash. To get cash, they sell assets. The second that happens, hidden losses become real, permanent, and visible. Capital disappears instantly. That's why this isn't about one bank. Across the system, trillions in securities and commercial real estate loans are sitting above what the market would pay today. Individually, each position looks manageable. Together, they form a trap. When pressure hits, behavior turns accounting fiction into insolvency. Stability isn't defined by how things look when nothing moves. It's defined by what happens when confidence breaks. And that is where this system is now most exposed. Now, we need to talk about scale, because this is where most people underestimate the risk. Losses don't become systemic because they exist. They become systemic when they stack, overlap, and interact. What the filings are quietly showing is not a single stress point, but multiple pressure fronts converging at the same time. Securities losses didn't disappear. Commercial real estate losses didn't pause. They're colliding. Start with securities. Banks still hold massive portfolios of bonds purchased when rates were near historic lows. Even after recent moves, many of those assets remain deeply underwater relative to today's market pricing. As long as deposits stay put, those losses can be deferred. But deferral is not immunity. It's a countdown clock tied to confidence. Now layer commercial real estate on top. Unlike bonds, real estate does not naturally heal with time. An office building doesn't recover because spreadsheets say it should. Cash flow depends on tenants. Tenants depend on demand, and demand has structurally changed. When loans are backed by properties that no longer generate enough income to service debt, the impairment is not theoretical. It's permanent. This is where the danger compounds. Securities losses weaken a bank's ability to raise liquidity without damaging capital. Commercial real estate losses weaken the quality of collateral and cash flow. Together, they remove both shock absorbers at the same time. Liquidity stress turns into solvency stress with frightening speed. And here's the part that rarely gets discussed clearly. Banks do not need catastrophic default rates to fail. They need losses large enough to erase equity. Equity is thin by design. A relatively small percentage hit to a concentrated asset base is enough to wipe it out completely. That's why surface-level reassurances miss the point. This isn't about whether the economy is strong in aggregate. It's about whether individual institutions have room to absorb surprises. Many don't. And when multiple weak institutions face pressure simultaneously, the system feels it. The real question is not if losses exist, it's whether the system can absorb them without triggering behavior that forces those losses into the open all at once. This is where timing turns stress into danger, because the system is not just dealing with losses, it's dealing with a clock. That clock is the maturity wall. A massive volume of commercial real estate loans was written during the era of cheap money structured with short to medium maturities and pushed into the future with the assumption that refinancing would always be easy. That assumption is now breaking. When these loans mature, borrowers face a simple reality. They must either repay refinance or default. Repayment is rarely possible at scale. Refinancing requires a new appraisal, tighter underwriting, and far more equity than before. But property values have fallen, cash flows are weaker, and lenders are no longer willing to stretch. That creates an equity gap that many borrowers cannot fill. This is the moment where delay turns into decision. What was once a negotiation becomes a deadline. And when hundreds of billions in loans hit that deadline inside a narrow window, the system doesn't have the capacity to save them all. Even healthy banks must choose where to deploy limited capital. The weakest assets are left behind. Default in this environment is not emotional, it's rational. When the equity is gone, fighting only increases losses. Handing back the keys becomes a financial decision, not a moral one. And each default forces banks to classify loans, raise reserves, or take write-downs that reduce capital immediately. Here's why this matters beyond real estate. These losses don't arrive gradually. They arrive in clusters. One maturity triggers another. One impairment forces a reassessment of similar assets. Suddenly, what looked like a manageable issue becomes a recognition event across portfolios. This is how quiet stress turns loud. Not through panic, but through deadlines. The maturity wall doesn't ask for optimism, it demands cash. And when cash isn't there, reality takes over. The system has been living on extensions and assumptions. The wall removes both. Losses alone do not create a crisis. Contagion does. And in banking, contagion is driven less by fundamentals and more by confidence. A bank can survive bad assets for a long time. It cannot survive depositors questioning whether their money will still be there tomorrow. The moment that doubt appears, behavior changes, and behavior moves faster than balance sheets ever can. We've already seen this dynamic play out. One failure creates fear. Fear triggers withdrawals. Withdrawals force asset sales. Asset sales expose losses. Losses weaken capital. Weakened capital feeds more fear. That feedback loop doesn't need panic to function. It only needs enough people acting defensively at the same time. Today, this loop runs faster than ever. There are no lines outside branches. There are taps, swipes, and transfers moving at digital speed. A quiet rumor on a Friday night can become a funding crisis by Monday morning. Banking no longer moves at walking pace. It moves at network speed. What makes this cycle especially dangerous now is visibility. Commercial real estate stress is no longer theoretical. Buildings have already traded at steep discounts. Defaults are public. When a few regional banks fail in close proximity, depositors at similar institutions won't wait for reassurance. They will move first. And here's the irony. Even if large banks remain stable, deposit flight toward them weakens the rest of the system. Regional banks lose funding when they need it most. Asset sales lock in losses. Losses destroy capital. Capital destruction accelerates withdrawals. This is how a contained problem spreads. Not through chaos, but through rational behavior under uncertainty. At this stage, the problem stops being abstract and becomes institutional. Not all banks carry the same risk, and not all stress is evenly distributed. The most vulnerable institutions are not necessarily the smallest, but the most concentrated. When a bank's exposure to a single asset class grows far larger than its equity buffer time stops being an ally. A few bad quarters can erase years of capital. Commercial real estate concentration is the fault line. Many regional and mid-sized banks relied on it as a primary profit engine for years. The loans looked safe, the collateral looked stable. Demand looked permanent. That stability encouraged repetition, and repetition created imbalance. Over time, portfolios became stacked in similar property types, often in the same geographic corridors, magnifying risk. Equity by design is a thin layer. Banks do not need to lose half their assets to fail. They only need losses large enough to overwhelm that thin buffer. A 10% impairment on a highly concentrated loan book can be fatal. That's why surface-level metrics can be misleading. A bank can look healthy right up until the moment it isn't. Regulatory thresholds exist to flag high-risk concentration, and a meaningful number of institutions sit uncomfortably close to or above those lines. These are not reckless operators. They are victims of a cycle that rewarded leverage and punished caution for too long. When conditions flipped, the same strategies that once looked conservative became liabilities. This is also why comparisons to past crises fall short. The structure of risk matters more than the headline numbers. In a concentrated system, losses don't need to be extreme. They only need to be poorly distributed. The danger isn't everywhere at once. It's clustered. And clustered risk is what turns localized stress into systemic concern. When losses start clustering, the conversation quickly shifts from markets to policy. This is where the backstop question enters. The deposit insurance system sounds reassuring until you look at the scale it's meant to cover. In normal times, isolated failures are manageable. The fund absorbs losses, assessments are raised, and the system moves on. In a wave of failures, the math changes fast. The insurance pool is small relative to the total deposits it implicitly protects. That doesn't matter when only one bank fails. It matters when several do. At that point, the problem stops being technical and becomes political. Decisions get made under pressure, not from a rule book, but from urgency. And history shows that when confidence is on the line, authorities choose speed over purity. That's when emergency measures appear, new liquidity programs, temporary guarantees, facilities with calm names designed to stop forced selling and slow contagion. These tools don't erase losses. They move them. Risk gets shifted from bank balance sheets to public balance sheets. The immediate panic eases, but the cost doesn't disappear. It shows up later, often in slower growth or rising inflation pressure. This is the uncomfortable trade-off. Stabilizing the system usually means socializing part of the damage. Allowing the system to clear fully risks a deeper contraction. Neither option is painless. The choice is about timing and visibility, not avoiding cost altogether. What often follows is not collapse, but stagnation. Banks that survive become defensive, lending tightens, capital is hoarded. Projects that once moved forward stall. This phase doesn't dominate headlines, but it shapes years. Credit becomes scarce, growth slows, the economy adjusts downward quietly. The real risk is assuming that stopping panic also stops damage. It doesn't. It only changes its form. Now, let's talk about what this means at the individual level, because systemic risk only matters if it reaches you, and it does often in subtle ways before it becomes obvious. The first misconception is that deposit insurance removes all personal risk. It doesn't. Insurance protects balances up to defined limits, and even then access is not always instant during a resolution. Short disruptions are common. In a stressed environment, timing matters. If large balances sit in a single institution, that concentration is a choice whether intentional or not. During calm periods, it feels irrelevant. During stress, it becomes a vulnerability. Understanding how much of your money is insured, how it's titled, and how quickly it can be accessed is basic risk management, not fear. The second issue is redundancy. Modern banking runs on interconnected systems. When one institution is resolved, cards can pause, wires can delay, and online portals can behave unpredictably during transitions. These problems are usually temporary, but temporary can still be damaging if payroll, rent, or critical payments depend on perfect timing. For businesses, this risk is magnified. A single frozen account can disrupt operations even if funds are eventually recovered. Having multiple banking relationships and tested transfer pathways is not a luxury. It's operational resilience. Investors face a parallel challenge. Instruments tied to commercial real estate cash flows can reprice quickly when refinancing freezes or defaults rise. Dividends can be cut, debt can be restructured, liquidity can vanish when it's needed most. Understanding exposure before volatility spikes is the difference between adjustment and reaction. None of this requires panic, it requires awareness. The goal is not to predict the exact trigger. It's to reduce dependency on any single point of failure. Preparation feels boring right up until the moment it matters. What happens next is shaped less by data and more by psychology. Financial systems rarely break at the peak of fear. They break in the gap between awareness and acceptance, that quiet window where the evidence is visible but the majority still believes stability will hold. This is where positioning happens whether people realize it or not. The first trigger is rarely dramatic. It's not a crash, it's a signal. A filing that shows an unexpected loss, a property sale that resets valuations lower than anyone anticipated. A regional bank quietly merged over a weekend. Individually, these events look manageable. Together, they change perception. And once perception shifts, behavior follows. Depositors don't audit balance sheets, they compare headlines, they notice patterns. When the same type of institution appears repeatedly in negative news, trust erodes across the category. Money moves toward what feels safest, not what is objectively strongest. That migration becomes the event. Markets react the same way. Credit spreads widen before defaults spike. Lending standards tighten before recessions are declared. Risk doesn't announce itself loudly. It withdraws quietly. Projects pause. Hiring slows. Financing assumptions change. By the time the data confirms it, the adjustment is already underway. This is why waiting for certainty is costly. Certainty arrives after prices move, after access tightens, after options narrow. The advantage belongs to those who recognize the transition phase, not to predict disaster, but to adapt early. The system doesn't fail all at once. It shifts, and those shifts reward awareness more than speed. Understanding where confidence is fragile, where exposure is concentrated, and where flexibility exists is the real edge in moments like this. The next chapter is about what to do with that understanding, not as a reaction, but as a strategy. This is where the story resolves not with panic, but with clarity. Financial cycles don't reward fear, and they don't reward denial. They reward preparation. When systems become fragile, the advantage doesn't belong to those who predict perfectly. It belongs to those who build flexibility before they're forced to. The first lesson is redundancy. You don't need to know which institution fails or when. You need to function if one does. Multiple banking relationships, tested transfers, a clear understanding of insurance limits. These steps aren't dramatic, but they are effective. Boring preparation consistently outperforms reactive decisions under stress. The second lesson is concentration awareness. Risk rarely appears everywhere at once. It clusters. Whether it's a bank, an investment, or a business dependency, anything that represents a single point of failure deserves attention. Diversification is not about maximizing upside. It's about preserving stability when conditions change. The third lesson is timing. Most damage doesn't happen during the loud phase of a crisis. It happens quietly when credit tightens, lending slows, and options disappear. Acting early doesn't mean acting extreme. It means adjusting before adjustment is forced on you. For investors, this means understanding liquidity, not just valuation. For business owners, it means stress testing access to cash and capital. For individuals, it means knowing where money sits and how fast it can move. None of this requires panic, it requires intention. Systems built on confidence don't fail when everyone is afraid. They fail when confidence shifts suddenly and behavior changes all at once. The goal is not to outrun that shift, but to avoid being trapped by it. If this breakdown helped you see the system more clearly, subscribe, share this video, and comment 1 to support continued coverage. Staying informed is the first layer of protection.